people would have laughed at you if you had told them a decade ago that they could get rich during a stock market crash. The internet has made it easier than ever to earn just about anything you want. So, with all this content and information available, how did you know which ones to earn from and which ones actually work? Luckily for you, Fortune Fastlaner, in today's video, we will be talking about how to get rich during a stock market crash. Remember that while the first step is completing any of this amazing information, the second and possibly more important step is taking action even if it's imperfect action. The threat of a stock market crash is always present. Because of 24-hour news cycles and the constant barrage of social media, every speck of information appears to be a compelling reason to start trading shares in your retirement or brokerage account. The powerful truth often repeated in financial circles is that making a lot of money, whether in the stock market or in business, does not necessitate a high IQ. It takes a ruthless cost control, a regimented routine, and a commitment to doing the right thing in the long run. It entails sticking to what you are familiar with, or your circle of competence. The formula for success hasn't changed in hundreds of years, and it doesn't appear to be changing anytime soon. Here are 5 guidelines for profiting from a stock market crash. Rule number 1. Invest in good companies. Purchase stock in good companies that generate real profits and attractive returns on equity, have low to moderate debt to equity ratios, higher gross profit margins, shareholder-friendly management, and at least some franchise value. Here's a suggestion. Good companies fare better under pressure, making a recovery more likely even if the stock price drops by 75% or more. Rule number 2. Use the dollar cost average formula to enter and exit your positions, buying and selling at predetermined rates and amounts. You will be able to avoid buying or selling a position at the top or bottom of the market. Because you will never be able to time the market, stick to a regular policy of stock accumulation or liquidation. Rule number 3. Reinvest your dividends. Reinvest your dividends to increase the effectiveness of your dollar cost averaging strategy. Jeremy Siegel, a renowned finance professor, has demonstrated time and time again that reinvested dividends account for a significant portion of the overall wealth of those who have made their fortune by investing in the stock market. Rule number 4. Keep an eye out for fees. Keep your expenses to a minimum. Actively managed mutual funds had an average management fee of 0.67% in 2018. An index fund, on the other hand, simply buys and holds a basket of stocks designed to track a specific index, most commonly the S&P 500 or the Dow Jones Industrial Average. A low-cost mutual fund or ETF could cost a little as 0.10% of assets per year, or $100 for every $100,000 invested, with almost no maintenance cost. Consider the case of a 25-year-old who contributes $10,000 to a retirement account. In 40 years, she intends to retire. At 65, that $10,000 would be worth $57,435, assuming a 6% annual return. The total cost of her services is, if her expense ratio is 0.10%, she will receive $1,698. If her expense ratio is 0.58%, she will earn $9,197. Consider this: the same investment with only slightly lower expenses, could provide you with an extra $7,500 in after-tax retirement income without ever touching your portfolio. Most investors are unaware of the importance of fees because they are deducted automatically from the mutual fund. In other words, they don't have to write a check. So, out of sight, out of mind is the case. Here's a tip. During a market crash, every penny you save in fees will increase your ability to weather the storm. Rule number 5. Have a plan B. Finally, create backup cash generators and income sources to help you build your fortune when Wall Street is in a slump. One of the most important things you can do to reduce your risk is to do just that. Even if you make $300 per year as an attorney or $2 million per film as an actor, knowing that you aren't reliant on your next paycheck to maintain your standard of living will make your life much more enjoyable. Consider Warren Buffett's Berkshire Hathaway wealth model, which employs a two-pronged approach to wealth accumulations. This method makes accumulating the first few $1,000,000 in net worth much easier. In essence, you live off your day job and use your regular salary to fund your retirement. Then you create additional cash generators to add to your investment portfolio. Rental homes, patents, and royalties are examples of passive income investments. They could also be small businesses run by a team you hire, such as a franchise business location or a retail storefront. That way, while you're going to work, picking up the kids, holding staff meetings, and filling up the car with gas, your cash generators are putting money into your brokerage, retirement, and other investment accounts. This strategy can help you save decades on your journey to financial independence as well as protect you if you lose your job. Consider the subsidiaries of Warren Buffett's company. Even if Duracell went bankrupt, he would still be wealthy because Berkshire Hathaway owns Geico. Even if that fails, he still has Nebraska Furniture Mart. There's always Benjamin Moore and Corporation, the paint company. If that gets destroyed, he could always fall back on Benbridge Jeweler if that was taken away. Also included are Kraft Heinz, Fruit of the Loom Companies, Borsheim and Brooks, a sportswear company. All of this began more than 70 years ago with a paper route that provided Buffett with his initial capital. Consider the small contingencies you can start incorporating into your financial plan right now. You will be better prepared to handle a stock market crash if you fund your investments from a variety of sources. During a stock market crash, what are the best investments? Because the factors shaping different downturns can be quite different, there is no sure bet for every stock market crash. Stocks in defensive sectors like industry, finance, and healthcare, on the other hand, typically recover well during a recession. How can I safeguard my retirement investments in the event of a stock market crash? If you are close to or already retired when the stock market crashes, the impact on your retirement funds will be much greater. If you are approaching retirement, the best thing you can do is shift your portfolio away from volatility by investing more in bonds, dividend stocks, and low-risk mutual funds rather than stocks. This will slow growth while preventing large losses in the event of a major downturn. Tax, investment, or financial services or advice are not provided by the balance. The information is being provided without considering any specific investor's investment objectives, risk tolerance, or financial circumstances, and may not be suitable for all investors. Past performance does not guarantee future outcomes. Investing entails risk, including the possibility of losing money. If you have the right mindset, you can turn a crash into a buying opportunity. Nobody can tell when a stock or the stock market has reached its lowest point. People can speculate, and every analyst hoping for a little bit of television fame will, but no one knows when a stock or the market has fallen as low as it will go. No matter how many previous predictions they claim to have gotten right. And while it's tempting to wait for better prices as an investor, that's a risky game to play. Yes, you may get a better deal by waiting, but you may also miss out on an opportunity if you wait too long. Market downturns, bear markets, or market crashes, whatever you want to call them, defy logic. A market correction lowers the value of overvalued companies that have underperformed, while also lowering the value of strong companies that have performed well. Your job, or at least the best path to accumulating wealth, as a long-term investor isn't to figure out where the bottom is. Instead, it's separating the companies with a bright long-term future where today's price will be irrelevant from those whose stock prices have fallen due to weak business fundamentals. When you consider the following examples, you will see that it's not always easy to determine. Is Netflix, NFLX, Get Netflix Incorporated report, a long-term market leader or a company with a massive spending problems that it might never be able to fix? Is Teladoc, TDOC, Get Teladoc Health Incorporated report, a market leader or an easy-to-copy company? Will Zoom, ZM, Get Zoom Video Communications Incorporated, will reports continue to grow once the world returns to a more normal state? Is there a long-term supply chain or inflation problem for retailers like Costco, Get Costco Wholesale Corporation report, Walmart, Get Walmart Incorporated report, and Target, Get Target Corporation report, or will the current concerns pass? On any of the questions above, there are investors and analysts who hold opposing viewpoints. But the best part about investing is that you only have to invest in stocks in which you have strong beliefs. What does it mean to be a long-term investor? Down markets are viewed by long-term investors as an opportunity to add to their portfolios. Before you can consider doing so, you must first consider what it means to be a long-term investor. A long-term investor purchases stock in companies that they intend to hold for many years, if not forever. A long-term investor usually has an investing thesis or justification for why they want to own the stock. Even if the company's stock price falls, that thesis should give long-term investors confidence in the stock. In other words, a long-term investor double-checks their holdings to ensure that the company hasn't made any changes that cause it to deviate from its thesis. Did the CEO, for example, change and the new leader make significant changes to the company's operations? Or has something significant happened in the market that has caused you to reconsider the company's prospects? Long-term investors recognize that many companies, including Amazon, do not achieve quarterly results. Instead, their leaders make the best decisions for the company to succeed over decades, not quarters. That's why, to use Amazon as an example, the company has been willing to lose money in order to invest in the infrastructure it requires for long-term success. Such moves can depress a company's stock price, but it's difficult to argue that Amazon and many other market leaders are mistaken in viewing their business as a long-term endeavor rather than a quarterly exercise in issuing press releases. In a bear market, how do you make money? Good companies are for sale in down markets, bear markets, and stock market crashes. If you believe in a company and may already own stock in it, you can buy shares with confidence, knowing that you are making the best decision for your future, even if the bear market continues and the stock falls. Long-term refers to years, if not decades, and a falling share price due to market or macroeconomic conditions allows you to buy shares and do dollar cost averaging. Instead of waiting for the best price, you buy shares as funds allow, averaging the price you've paid for the company stock. If the share price has fallen below what you originally paid, a falling market allows you to lower the average cost per share of your best holdings. The problem, and it's a big one, is that long-term investing entails holding stocks for a long or very long period of time. That may mean your portfolio has taken a hit right now, but if you believe in the long-term prospects of the companies you own, holding and adding to those positions makes sense. While we are proponents of long-term investing, we are far from alone, as legendary investor Warren Buffett has followed similar principles and delivered some well-known quotes on the subject. Someone is sitting in the shade today because a tree was planted many years ago, he explained. The Oracle of Omaha has also said two other things that demonstrate this philosophy on a regular basis. Don't even consider owning a stock for 10 minutes if you aren't willing to own it for 10 years. Forever is our favorite holding period. Is it necessary for long-term investing to be your sole strategy? Of course. Not being a more active trader can also earn you money. Here's 5 ways that you can profit from having the stock market crash. The first way to profit from a stock market crash is simply by either shorting a stock or by shorting the market itself. Now, short selling is a bit of an interesting process to kind of wrap your head around, and it does require a margin account, but essentially a normal investor when they are going out to buy a stock. What are they doing? They are trying to buy low and then sell high, whereas with short selling, it's flipped around the other way. So, for short sellers, they actually sell high first and then they buy low later. How do they do that? It seems a little bit strange, right? And it is a little bit complicated. What happens first is they are going to borrow somebody else's shares from them through their stockbroker, and they are going to sell those shares straight away. Then what they are hoping is that over time, the share price goes down because they have to buy back the shares that they borrowed to return them to their owner. So, if they are able to borrow the shares and sell them high, and then the stock price goes down, and they're able to buy back lower and return those shares back, then that works out for the short seller. They profit from the decline in that share price because they are able to sell high, and buy low, they profit. The difference now with this strategy is you can just pick individual businesses, individual stocks to short, or you can short the whole market. By shorting a market tracking ETF like something like SPY. Now, personally, we don't short stocks. It's not something that we look to do, and the reason for that is because it can actually be quite risky. It has the potential to lose you an unlimited amount of money. For example, if you are just a normal investor and you make an investment in a particular company, the worst thing that can happen is you lose 100, then the stock goes to 0. But with short selling, you are borrowing the shares and then selling them for that fixed price first. You are then hoping that you can buy them back cheaper and return the shares back. But there is no limit as to how high share prices can go, right? So what happens if you sell the shares at a fixed amount first and then the stock just keeps going up and it keeps going up? It could continue to go up, it could just keep going up, at which case you still have to buy the shares back to return them to the owner. So, if you sell the shares for that fixed amount and then the share price just goes up and up, you still have to buy back the shares, so that could get very expensive for you very quickly. Overall, that's short selling in a nutshell. It's a little bit hard to understand, and it is a little bit risky if the share price doesn't move as you want it to in the short term. Now, let's talk about the second way that you can potentially profit from a market crash, and this way is very interesting. It's by investing in inverse ETFs inverse. ETFs essentially function like the opposite of normal ETF. The idea of an ETF is they buy a diversified group of stocks, and the ETF tries to mimic the performance of a particular index. If the Nasdaq 100 goes up by 2%, the Nasdaq 100 ETF will also go up by 2%. Now, if we look at the inverse ETF for the Nasdaq 100, if the Nasdaq 100 goes up by 2%, the inverse ETF for that will go down by 2% and vice versa. If the Nasdaq 100 goes down by 2%, then the inverse ETF for the Nasdaq 100 will go up by 2%. The objective of inverse ETFs is they try to mimic the opposite performance of a particular index, and one important thing to note is that even though these investment vehicles are called inverse ETFs, it is definitely worth jotting down that these investments do not hold individual stocks. Even though they are called inverse ETFs, they certainly don't look the same as a typical ETF. In fact, they are mathematically constructed through the use of various derivatives, usually futures, so that they can mimic the exact opposite performance of the particular index that it's looking at on a day-by-day basis. That's the other important thing to note with inverse ETFs. These inverse ETFs are not in any way, shape, or form long-term investments. They are only short-term investments because these inverse ETFs get rebalanced daily. They get rebalanced daily to maintain a constant leverage ratio. What that means is that the inverse ETF will only perform its objective for that specific day, then at the end of the day, it gets rebalanced, and it will perform its specific objective again on the next day. So, if the Nasdaq 100 went down by 2%, in a day, the inverse ETF for the Nasdaq 100 PSQ will go up 2% that day. However, if the Nasdaq 100 went down by 10% in 1 year, PSQ would not go up 10% across that year. It's because of that daily rebalancing, and if you look at any inverse each you have over a lengthy period of time, what you'll notice is the inverse ETFs tend to underperform, and they underperform because of this whole notion of rebalancing every single day. That's a story of inverse ETF. There's also what they call leverage inverse ETFs, which essentially amplify the opposite return of a particular index. So, you could get like 2 times the opposite of the Nasdaq 100 or 3 times the opposite of the Nasdaq 100, but that stuff is just way too scary for us. So, let's just leave that where it is and move on. Let's talk about the third way that you can potentially make money from the stock market crashing, and this is an interesting one that is definitely quite tricky to wrap your head around if you are fairly new to investing. It is either by buying put options or by selling call options. Options are just contracts between 2 investors, and there are 2 types of options. Contracts that exist, there are call options, and there are put options. Now, this is where it gets a little bit tricky. Call options give the buyer of that option the right, but not the obligation to buy shares from the seller at a predetermined price, and then put options give the buyer the right, but not the obligation to sell their shares to the option seller at a predetermined price. Very confusing, and we are not going to go too much into detail for options in this video just for the sake of time. The way that you are going to make money through the market crashing with options is, as we said before, either buying put options or selling call options. Let's firstly talk about buying put options. Buying put options means that by buying that contract, it will give you the right to sell your shares at a predetermined price to whoever sold you that option. So, if your stock goes down horribly, then that's a good thing for you, because what you have bought in that contract is the right to sell your shares at a predetermined price to the person that wrote you that option. So, this makes sense for you because in a market crash, you might have the ability to sell your shares to that person for a much higher price, and then you can just sell them and then go back and buy the shares back on the open market for much less. So that's the idea of buying put options. That's how you can make money through buying put options when the stock market crashes. Let's talk about the flip side of that. You can also make money by selling call options to other investors. So this gives the option buyer the right to buy your shares off of you for a predetermined price. However, if you make that option contract and then the market goes down horribly, your stock goes down horribly. Well, then for them, they are getting a much better deal if they just buy those shares in the open market because the price has gone down so much. They're not going to come knocking, right? They are not going to come and exercise that contract and say, actually, I would like to buy your shares for our predetermined price that we made 3 weeks ago when the stock price was way up here. When they can just go out and buy the shares on the market for way less. So, In that instance, they will just let the contract expire because all options have an expiry date. And then you will be left with a small profit because, of course, you sold them that contract. You collect that profit that you made by selling them the contract. That is how you could potentially profit through selling or buying options in times where the market is crashing. For the last 2 points, we wanted to talk about how long-term investors end up making money through stock market crashes. And here's an important phrase to remember. Long-term investors don't make money when the stock market is going down. They make money because the market is going down. So, firstly, if you are a passive investor, aka you are someone that buys market diversified investments, and you just keep adding to that same portfolio over time, trying to mimic the return of the overall market. You are going to just continue to do that for decades, then obviously market crashes simply present really good buying opportunities in your dollar cost averaging cycle. Because passive investors following the dollar cost averaging strategy are always buyers of stocks. Then, any market downturn, especially if you are early on in your investing career, any market downturn is just an opportunity. And as we just said, if you are someone that is still quite young, you're early on in your investing career. Then, market crashes in the early days can significantly increase your long-term rate of return. While you may not make money during the market crash, the fact that the market is crashing presents you with an opportunity that will help you make a much stronger return in the long run. So, that is the fourth way of making money because the market is crashing. The fifth way we wanted to talk about is simply being able to buy high-quality businesses at a margin of safety prices. Having the market crash may not bring all of those high-quality businesses that you follow down to a margin of safety price. But of course, having the market crash is going to be much more likely that you will see some opportunities at least. Some of the companies you follow just because the market is coming down, and if you find yourself in a situation where you have got a group of high-quality businesses and they have been brought down to margin of safety prices just because of a short-term market-wide event, then this is the absolute dream. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we have delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you will start to see results. See you soon.